Why are trillions of manufacturing dollars moving away from China? And why is the ongoing conflict in Iran accelerating that shift? Every decade or so, the global economy quietly rewrites its own rulebook. The factories move, the capital follows, and by the time most people notice, the map has already changed. What we are watching right now is not a political story, it is a financial and structural rebalancing that took decades to build and may take decades more to fully unfold. The question is not whether it is happening, the question is what it actually means for the world economy. Welcome to Capital Anatomy. Today we are looking at the forces pulling manufacturing capital out of China, and why the situation in the Middle East is adding a new layer of pressure to an already complicated picture. For most of the past 3 decades, China operated as the undisputed center of global manufacturing. The logic was straightforward. A vast labor supply, rapidly improving infrastructure, deep industrial supply chains, and a government willing to prioritize export-led growth above almost everything else. The combination was difficult to replicate anywhere else in the world. But that equation has been changing. Slowly, then all at once. The Purchasing Managers' Index, a measure of factory activity, tells part of the story. In October 2025, China's official Manufacturing Purchasing Managers' Index came in at 49.0, marking the 7th consecutive month of decline. Sustained readings below expansion territory over multiple quarters reflect something structural, not cyclical. Foreign direct investment data reinforces that picture. In 2021, net foreign direct investment into China exceeded $344 billion. By 2024, that figure had fallen to approximately $18.6 billion, the lowest level in decades. That kind of collapse reflects a shift in how global capital evaluates risk across an entire country. A significant part of that reassessment comes down to demographics. China's median age is approaching 40, and the cohort of workers aged 20 to 24 is projected to decline sharply over the next decade. As younger workers become scarcer, labor costs rise. Manufacturing wages in China are now approaching $4 per hour and higher in some regions. No longer the dramatic cost advantage it once was as relative to Vietnam, Indonesia, or other parts of Southeast Asia. The deflationary pressure inside China's manufacturing sector adds another layer of complexity. China's Producer Price Index has been negative for over 3 years, with readings as low as negative 2.3% in early 2025. When prices keep falling while production continues, inventory accumulates, margins compress, and the only way to keep orders coming in is to cut prices further. Chinese manufacturers have a term for this dynamic, neihuan, often translated as involution, internal competition that intensifies without producing meaningful gains for anyone involved. On the policy side, the tariff environment has added a layer of strategic risk that did not exist a decade ago. The tariffs currently applied to Chinese goods entering the United States represent some of the highest trade barriers seen since the 1930s. And the calculation for companies has shifted from how efficient is manufacturing in China to how exposed are we if the trade relationship deteriorates further. The Uyghur Forced Labor Prevention Act has added a compliance dimension that companies can no longer ignore. In 2025 alone, the list of entities subject to enforcement under this act expanded from 20 to 144. United States Customs inspected over 16,000 shipments, valued at nearly $3.7 billion. For any brand selling into the American market, supply chain exposure to affected regions in China now carries legal, reputational, and operational risk simultaneously. Even shipments that clear inspection can tie up capital for days or weeks, which is a real cost regardless of the outcome. Environmental, social, and governance reporting requirements are pushing in the same direction. Publicly traded companies are increasingly required to trace and document their supply chains in detail that was not standard practice 5 years ago. The more opaque a supply chain, the more expensive compliance becomes. The result of all these pressures together is what analysts are calling the China Plus One strategy. The core idea is not to exit China entirely, and that would be operationally and financially impractical for most large manufacturers. The idea is to avoid concentrating new investment and new capacity in China. The next factory goes somewhere else. Mexico has absorbed a significant share of this redirected investment, particularly for companies that supply the North American market. In the first half of 2024, our foreign direct investment into Mexico reached $31.1 billion. The appeal is straightforward. Proximity to the United States reduces transit times dramatically and eliminates much of the tariff exposure that comes with manufacturing in China. Vietnam has become the preferred destination for consumer electronics production. By the end of 2025, Vietnam is projected to account for 20% of global iPad and Apple Watch production, 5% of MacBooks, and approximately 65% of AirPods. Labor costs remain competitive at around $3 per hour, and the electronics manufacturing ecosystem has grown substantially over the past decade. India is absorbing a growing share of smartphone assembly, with estimates suggesting that roughly 25% of iPhones sold globally may be assembled there by 2026. And Thailand and Indonesia are also positioning themselves as manufacturing destinations. Thailand through its automotive base, Indonesia through its access to the critical minerals needed for electric vehicle battery supply chains. Companies like Asus have reportedly shifted over 90% of motherboard and personal computer production out of China, distributing that capacity across Thailand, Vietnam, and Indonesia. However, there is an important distinction that tends to get lost in the broader narrative. Final assembly is mobile. Supply chains are not. The upstream inputs, precision components, specialized chemicals, intermediate materials, remain heavily concentrated in China. A product labeled Made in Vietnam may still contain components that originated in Chinese factories. The geography of final assembly is changing, and the geography of industrial production is changing more slowly. The domestic economic consequences of this manufacturing slowdown are significant. Estimates from Bloomberg Economics suggest that China's housing crisis has erased roughly $18 trillion in household wealth, with the housing sector's share of the economy declining from around 24% to 19%. Property has historically been the primary store of wealth for Chinese households. When that asset class comes under pressure, consumer spending tends to follow. Household consumption in China currently sits at around 40% of gross domestic product, well below the approximately 68% figure for the United States. The urban youth unemployment rate reached 17.3% in October 2025, and local government finances have contracted alongside the property market. And Beijing is aware of these dynamics and is actively trying to reorient the economy toward higher value manufacturing. Electric vehicles, batteries, semiconductors, artificial intelligence. China has already become a significant force in electric vehicle production, exporting nearly 5 million vehicles in 2023. But Western markets have responded with tariffs, the United States at 100% on Chinese electric vehicles, Europe with anti-subsidy duties approaching 40% in some categories. The transition from low-cost mass manufacturing to high-technology production is not a straightforward path, and it creates real distributional challenges for the existing workforce. Now, layered onto all of this is the situation in the Middle East. China imports approximately 1.38 million barrels of Iranian oil per day, representing close to 90% of Iran's seaborne oil exports. The conflict involving Iran introduces uncertainty into that energy relationship. China also sources a substantial portion of its oil from other Middle Eastern suppliers: Saudi Arabia, Iraq, the United Arab Emirates, Oman, Kuwait, and Qatar collectively supplied roughly 4.9 million barrels per day to China in 2025, accounting for about 42% of total imports. Much of this oil passes through or near areas affected by the current conflict. When energy costs rise and freight insurance costs increase, the economics of maintaining long supply chains from Asia to Western consumer markets become more difficult to justify. This is an additional pressure on top of the structural shifts already underway. What emerges from all of this is not a simple story of one country rising while another falls. It is a story of a global manufacturing system that became highly concentrated in one geography over several decades and is now, under the combined pressure of demographics, policy, trade friction, compliance requirements, and geopolitical risk, beginning to distribute itself more broadly. China still accounts for roughly 1/3 of global manufacturing output. The supply chain infrastructure, the industrial expertise, and the scale of the Chinese manufacturing base have no equivalent anywhere else today. But the direction of new investment is shifting, and when that pattern persists across enough companies and sectors, the cumulative effect begins to reshape the map. 3 things are worth keeping in mind as this unfolds. And the capital today does not simply chase the lowest wage, and it follows a more complex calculation that includes political risk, legal exposure, logistics reliability and proximity to end markets. The movement of supply chains happens in stages. Assembly relocates first, upstream inputs follow much more slowly, and China's industrial base remains deeply embedded in the global economy. The question is not whether China matters, it clearly does. The question is whether its position is as unchallenged, as cost-effective, and as low risk as it was 15 years ago. On all three dimensions, the answer appears to be shifting. That shift, gradual, structural, and still very much in progress, is what is behind the movement of manufacturing capital that we are watching today. The world is not abandoning China's factories overnight. It is doing something more deliberate, building alternatives, hedging exposure, and gradually redirecting new investment toward geographies that carry a different risk profile. The manufacturing map is being redrawn not with a single bold stroke, but with thousands of smaller decisions made in boardrooms, by risk committees, and through updated compliance policies. That is how structural economic change actually works, not as a single event, but as an accumulation of rational adjustments that, taken together, move the center of gravity. If this kind of analysis is useful to you, the kind that looks past the headlines and into the underlying mechanics of how money and industry actually move, subscribe to Capital Anatomy. Hit the like button if this gave you a clearer picture of what is happening in global manufacturing, and share it with someone who wants to understand the economics behind today's news. We will see you in the next one.